Welcome to the Professor Lending Institute, where we make sense of housing economics and the home buying process. I'm Jordan Steffaniak, president of Professor Lending, licensed loan originator, and your home buying professor. In today's episode, we're going to be covering the topic of mortgage rate pricing and how that exactly works and what to look for and how to understand it. It's going to be very simple, very quick, and we're going to get right to it. Before we jump into this, I do want to remind you to go ahead and like the show if you found this valuable in any sense, or like the video, and then you can subscribe to the channel so you don't miss any of the quality content that comes out, and you can drop a comment if you have questions or ideas. So I'm going to share my screen and walk you through a couple of things here. So this is going to be pretty straightforward. All right, so what you see here is just a simple sort of LTV FICO grid is what it's called. So you've got your loan to value up here, which is just the percentage of equity essentially you have in the house. If you have a loan that's worth 80% of the value of the house, then it's 80% LTV. So the loan to value ratio, the value of the home, and then your FICO score here on the left side. Of course, I'm recording this. Vantage score is suddenly being apparently accepted, but I don't think anyone's actually doing it yet because there's all sorts of technological issues that go into it, but that's another story. Either way, you'll probably have a Vantage score here eventually on the side, but it's going to be a simple grid. And basically what lenders do is they're going to price this negatively the further you get down here. The lower FICO you have, the higher LTV you have, you're going to get basically a charge on your loan. So the better FICO you have and the lower LTV you have, you're not going to get this sort of basically surcharge for the risk that you're presenting. So the way lenders basically have this, scroll down here to show you, they have a base price for whatever the rate is. And then based on all these different factors, this is just one example. There's multiple grids and multiple things that go in here called LLPAs, lender level pricing adjustment. You have your base rate of what it costs, and then you're going to basically stack on these various things to get to a final price for what the loan is going to cost you. So when somebody comes and talks to me and says, what are your rates? I say, well, I don't know. It depends on your credit profile. It depends on your FICO. It depends on your LTV. It depends on all sorts of factors to understand what you actually are going to have as a rate. There's no one size fits all rate. There's not just everybody gets a 6%. It's all going to be dependent on these things. So you're going to look here, and you're going to add in this case, so let's say your FICO is 700 and your LTV was 81%. You basically get a 1.5 charge. So this is basically this is going to be a multiplicative, if that's the right way to say it, factor on your loan amount. So if your loan was $250,000, you'd be multiplying it by basically 1.5 in this scenario. So that'd be $3,700. In addition, would be charged for that interest rate that you were applying for. So what happens then is you basically start with that base price, which whatever the cost is, in this case, I just have an example, 0.284, and then you'd have these different adjustments. So in this case, we've got a purchase for greater than 50 years. They have a charge here, but then you're getting a discount credit for this, and then you're going to look at the total adjustments as this, and so your final price right here is minus 0.099. And so what you do with that then for this 6.375, you can basically, what a lender's going to have is a rate sheet here. They're basically going to have all the rates listed, and you're going to have the discount points for wherever it's at, and that's going to be the total cost. So when you look at a lender, you can actually pick any of these rates. They're just going to cost different amounts. So this one is basically the one that's the closest to you're not paying anything for it. You're actually getting a $500 credit in this case. Now, let's say you had a better FICO and you had better terms. Your no-cost rate may be up here. So like I just said, that example, I took $3,750 was the charge for it. Let's say you fit in the bucket that's a 0. Maybe you're up here at 6.125 is your rate at no cost in that case. It would be about $200 you'd be paying for it. But you as a consumer, you can pay this charge here. If you want a 6% or a 5.99, you can pay to get there, or you can choose to get a credit. You could take a higher rate and get a credit. So the way to think about, is this valuable to me, is simply to take that amount, that 70, let's say you wanted the 6%, you were at the 6.375. You'd look at the total principal and interest here on both of these. So you'd save $34.94 minus $33.57. That's $137 a month you'd save if you went here. But you got to think, okay, I'm spending $7,800 essentially to move from 6.375 to 6. how long is it going to take me to recoup that $137 savings per month? So let's just say 7354 plus 553. So that's $7,900 that you're paying. Divided by 137, that's 57.7 monthly payments it's going to take to break even. So that's almost 5 years. So you've got to think in your head, am I going to stay in this house for over 5 years? Am I going to stay in this loan for over 5 years? Do I anticipate rates dropping or I might refinance for some reason? And if the answer is no to those, then it doesn't make sense to pay that large sum of money up front. There's no value in doing that. It's more valuable to stay here. And then conversely, you can look here and see the credit and say, okay, is it worth taking a higher monthly payment to get this lump sum up front? Maybe you know you're going to move in 2 to 3 years or you're thinking about that. Maybe it makes actual sense if you can qualify to take a higher rate. So these are things to consider. And here's the other thing to consider. So when you go on the internet and you look at mortgage interest rates, what you're going to do is you're going to share. Let me share the screen here. You're going to go to a place like Bankrate. This is what a lot of people do. You know, they Google it and it shows, and that's like one of the first things that shows up. And you're looking for mortgage rates. You plug in a couple of things in here. You plug in your zip code, your purchase price, your down payment, your credit score, some basic things. That's going to show you a list of rates. And you're going to look here and say, right now, rates average 6.75, maybe a little bit higher. You're going to see 5.79. Wow, that's awesome. 5.875. Wow, that's awesome, right? What you don't understand or see, it's because it's hiding, is this thing called points. You are paying 2 points to get this 5.79 rate. So that's a part of the charge. The 2 points is $9,900. So you're paying 2 full points. You're paying $10,000. So in that example that I showed earlier, if you want to go back and circle back, you're paying $9,900 to get that. If you were to look at that scenario that I did, which was a lower loan amount than this, $10,000 is going to get you to 5.875. So that's how they're doing this. So it can be a little bit deceptive because you might talk to a local lender and they give you what, to me, the honest thing to do, the most forthright thing to do is to give you the rate that costs nothing, essentially the closest thing to par, to zero as possible, and say, look, you can go lower, you can go higher if you want, rather than to advertise a lower rate at with paying points. So that's the whole, when you hear people saying paying points, all it is paying a percentage of the loan amount to drop that interest rate for you to 6% or 5.5% or whatever. You pay a point, you pay 2 points, you pay 1.5 points, whatever it is. That whole structure that I showed you is how it ends up working out. So it's not super complicated. There's a lot of different elements that go into it that will either give you sort of a little bit of credit or count against you and make it a little bit more expensive as a charge. But either way, everybody has access to this whole rate sheet, essentially. Lender's going to have a little bit different view on the sort of base rate. But fundamentally, that's your option there. You can just pick anything across the tab. So let me know what you think, or if you have questions, or if you have thoughts, ideas. Either way, I'm happy to help you out here. I like to take questions, so you can chat me here on YouTube, or you can shoot a message on our website, whatever works. Hopefully this is valuable, and I look forward to thinking with you guys soon.